Last week I was talking about earnings and I was talking about getting yourself into earnings. But you know what I thought I'd do this week is talk about volatility. I want to talk about the top most volatile stocks this week. To do that, let me set you up with what I'm talking about. Most traders end up buying into earnings at these vol tops right before the earnings end up happening. So that is due to what we do see, which is implied volatility. Now, I think it's easier sometimes to track volatility than it is to track price, because volatility, we find for certain stocks, always tends to move higher into earnings and almost always tends to drop after earnings. So if you can look and track volatility into earnings, you're able to, with earnings coming up this week and possibly even next week for certain stocks, you can find those stocks that have the biggest, most volatile pushes coming into their earnings season. And so I want to talk about those top 5 for this week. Those top 5 include Molina Healthcare, Kensington Capital, Joby Aviation, Centene, and UnitedHealth Group. I want to look at each one of these because there is a common denominator for each one of these setups, or at least most of them. All right, let's talk about Molina Healthcare first. So Molina Healthcare, and looking at a chart that goes back into mid-March, you can see that Molina has traded from a high of about 360 down to, look at the lows that are happening right now at 180. This stock has been cut in half since about April 1st. All right, so while the rest of the market has been moving higher since the beginning of April, this is one company that hasn't, Molina Healthcare. And it did take a huge gap down on some bad news that happened at the beginning of this month. And that's when the volatility really started to climb. So what you see here is a 37 and a 65. The 37 is the lowest volatility you see on the chart. The 65 is the highest volatility you see on the chart right now. This puts Molina Healthcare as the number 1 most volatile optionable stock, because that's what I track, optionable stocks that are out there. Its earnings are estimated to come out on the 23rd of July. And if you see what happened last time the earnings came out, volatility dropped. We'll expect volatility to drop again. Where does price go? Well, that's anybody's guess. Kensington Capital comes in number 2. The symbol is QS. Kensington, now this was a $4 stock. All right, a $4 stock that hit a high on Friday of about 15. It's had a bit of a pullback, but when you have a $4 stock that goes from 4 to 14 or to 15, and then today has a low below 12, all right, that's going to kick the volatility up. The volatility has been moving along with price here for the better part of June and into July, and as you can see, the vol was a 60 down here around the beginning of July. In less than a month, that vol has gone from 60 to 140. So it's more than doubled in price. Next earnings are also on the 23rd. Number 3, Joby Aviation. Joby Aviation is a stock that was at $5 a share back at the beginning of April. It has jumped up to 18.5 and is trading right now at $18.22. Look at the volatility on this one. It has also gone from low to high. I don't know where my boxes went, but the low was trading around 60 and the high was about 112 on the IV. So this one too is also close to a double when it comes to its IV just in the last couple of months. Now, Joby Aviation has its earnings in 16 days. That will be on the 6th of August. Next is CNC, which is Centene. Centene has earnings in 4 days on the 25th of July. Look what's happened to the stock. It has moved from about the mid-60s down to, get this, $27.77. This one has more than been cut in half. And that vol, well, it's gone from a 30, almost tripled at 86 before dropping. Now, you can see that there was a big move that happened here as well, where also on the 1st, that Centene has dropped from the stock prices around 50, mid-50s down to low 30s, been dropping ever since. That vol's on the rise, and now that vol's on the rise because of earnings, because of potential what's happening with the stock here in 4 days. And finally, and I find the next one to be the most interesting to me because it's the one that's in the headlights of healthcare. All right, so Medina, yeah. Centene, yeah. But UnitedHealth Group, UNH, UNH really took it on the chin with all the news that's happened with it. And United came down. And then just on this chart, you're talking about $600 a share in the middle of April. By the time we got to the middle of May, we were down to 250. It did claw its way back above 300, but in the last week, it's dropped back below 300. Now trading at 284.28. The volatility's gone from 30 to 74. That is more than a double, but that was back in April. What's it done since then? That 30 has climbed back up to the high 40s. Earnings are in 8 days, so earnings will not be until next week. That gives us another week for this to continue to climb as people are holding their breath to see what's going on. More importantly, not with just earnings, but forward guidance is what they want to hear about. So, I look at United Healthcare and I think, really, how bad could it get? And if it really is one of those too big to fail companies where the government has to come in and help them out, if that's even the case, maybe it's not. But if you look at it that way and you think this $600 stock, which became a $250 stock, might be worth it $250, well, there's a way to play this. There's a way to play all 5 of these if you have a reason to be bullish or bearish. And so are they tradable? Yes, they are. So buying options is not an option here, okay? It's definitely not an option. If something fits your bull or bear signals with these 5 stocks that I just talked about, consider selling option premium because the volatilities are expensive. The premiums are high. You could choose to sell naked options, naked calls or naked puts. All right? Those do have their own reward to risk ratios and come with margin. Or if you want to get a lower cost and a potential lower risk other than selling naked, you could consider credit spreads. That limits the margin, risk, and cost. And so for being bullish, you could sell puts or you could sell put spreads. And put spreads are selling a lower strike put, buying a higher strike put, and receiving a credit for that. Bearish, you could sell calls, all right? Calls are going to come with an exceedingly high premium because we don't know where the upside is, like we do with the downside for puts. Or you could sell call spreads again. Call spreads come with a lower cost and a lower risk. But there's your top 5 volatile stocks and how, if one of them were to hit one of my bull or bear strategies, how I would want to trade it.